Let's turn to the broader markets as well. Our next guest is revising his EPS growth forecast for the year lower, but he sees some buying opportunities in healthcare. David Kostin joins us this morning, Goldman Sachs chief U.S. equity strategist here at Post 9. DK, great to have you back.
Nice to see you, Carl.
What was your growth forecast? What is it now?
It was 11%, now looking for earnings growth of 9%. And the way to think about that is the fourth quarter results came in slightly better than we had anticipated, but the weakening of the economic outlook would suggest that the growth level of our earnings is going to be pretty similar to what we anticipated before. That's why the growth rate comes out from 11 to 9%.
Right.
And the way the market looks at it is not this year's growth rate, but next year's earnings growth rate, and we're looking around 7%.
Which was unchanged.
Unchanged. So the level of earnings is unchanged. The starting point a little bit higher because the fourth quarter results were pretty good.
And hence your year-end S&P target is also unchanged.
Correct. It's 6,500, which would be roughly 11% up from the current levels. I think the way to think about the most recent activity has been the market or investors sometimes pay for excitement and sometimes they pay for boredom. And when they think about paying for excitement, when Trump was elected, the enthusiasm, prospect of potentially less regulation, potentially lower taxes, a more sort of business-friendlier environment, that animated a lot of spirits, and the equity market rose pretty strongly, particularly cyclicals, outperforming defensive stocks by a lot. Now, the market is paying for boredom because the uncertainty around tariffs, which, of course, you speak about every day, and there's uncertainty, the market's rotated pretty significantly towards some of the healthcare, some of the consumer staples, some more defensive-oriented stocks. The way I think about it is that the companies who are less sensitivity, sort of insensitive to some of the vicissitudes of trade policy, is where you want to be owning the market. And you can think about this owner of this building right now. International Exchange, ICE. You can think about MSCI. You can think about some of the healthcare companies, Thermo Fisher. You can think about Agilent. Companies there are trading less sensitive to how the cyclical diverse defensives or how the trade exposed basket. So that's the discussions we're having with clients right now.
Would it lead you to some areas of the Mag 7?
Apple could be an example, potentially of a company.
Right.
A lot of uncertainties around the exact policies, and you recall that the president had talked about a tariff on Saturday, and then on a Monday it was reversed, and so there's a lot of uncertainty there. The focus of a lot of portfolio managers has been on not the Mag 7 as the sort of part of the hyperscalers and the building out of the infrastructure for the AI revolution, if you will. It's been those companies that are going to be using that technology to amplify their revenues. That's really a big area. A lot of the companies in the software industry, because part of the data structure that we found in conversation with clients, the data needs to get structured in a way that can be used. Companies can use it more effectively. And those companies, you can think of MongoDB, company down a lot last year. Last year was really the trade around infrastructure. And this year, the focus has been much more on which companies could benefit their sales as a result of AI.
But on tariffs, David, where does it show up for companies? Is it in margins? Is it in hiring, as we just talked about? Is it in EPS, sales? Where do you expect to see the impact most?
Well, it's likely to be a little bit on the unit volume, potentially, and a little bit on the margin front. And so our model of earnings would suggest that if tariffs, which are currently around 3%, if they would go up by potentially 5 percentage points to 8%, Sarah, that would reduce our earnings estimates by 1 to 2%. So instead of growing at sort of 9% this year, 7% next year, it could be slightly lower as a consequence.
So every
of that.
time he comes out with new tariffs, do you revise your earnings expectation?
Well, no, we have a sensitivity model, so we understand what the impact would be. And the reason we don't officially, publish a new forecast is because the timing, the specifics of when the tariffs may in fact be imposed, whether they may be renegotiated. So we have a model we talk about with portfolio managers and clients about how it would affect under different scenarios, but really once things get clarified, then we can actually publish those estimates. But the sensitivity factor is a 5 percentage points move in tariffs would be around 1 to 2 percentage points in earnings.
I was talking about interest rates and how bond yields are falling, and I wonder if that is an offset for some of this tariff disruption, because ultimately that should be a good thing for the economy.
The most important, far and away, most important variable driving sales and margins for any company is GDP growth. GDP growth in America. Second is GDP growth around the world. The other variables in a model, interest rates, oil prices, inflation, have differing impacts on different sectors, but they're in aggregate much less important than really growth. It's really a story of growth, and the idea of the uncertainty around the tariffs does raise questions about the sustainability.
When it comes to growth, I mean, we get jobs on Friday,
right?
Number of other things. I don't know where you guys are. You're just going to defer to your chief economist on this?
Well, I have an excellent economist, Jan Hatzius, my colleague, so he'll be here to tell you.